Hi folks, I'm Dr. Jeff Camarda with a word from Jeff from our Wealth Advisor newsletter. And I call this one Come the Season of the Witch. Now fall traditionally is a very dicey time for stocks. For 2017, this is especially so. The geopolitical landscape grows increasingly dark, led by the madness on the Korean peninsula. Other hotspots abound, and the U.S.'s relations with allies and other superpowers has entered a period of turbulent flux, really unlike anything in recent decades. Despite all of this, the U.S. bull market continues to bounce higher on waves of frothy valuations, making fresh highs in mid-September. Clearly, it has become quite elongated a tooth. That's elongated tooth. Now being the second longest bull market on record, yet still chomps blithely away. To misquote Bette Davis, we may want to fasten our seatbelts against the coming bumps. For one thing, stocks are sporting bloated valuations not seen since the dot-com era, which, as you remember, did not end well in 1999 and 2000. For another, the Fed is clearly set on raising interest rates, and while now dithers over stagnant inflation and may pause a bit, the odds of a miscalculation, either keeping rates too low too long and sparking inflation, or raising too fast and stifling the recovery, are higher now and could derail the market in either direction. The recently falling dollar plays into the former scenario, dropping the relative price of U.S. goods, both here and abroad, goosing production and employment, and nurturing inflation. All of these risks and many more on top of a world that looks more complicated and dangerous than it has in years or even in decades. For these and other reasons, Camarda still expects a pretty sharp stock market correction, a song we've been singing for much of this year. No, this is not guaranteed, and the market may soar on wings of hope far higher yet. And no, it may not be imminent, as hope can linger for a long, long time indeed. But we think it is the way to bet, given the cold math of reasonable valuations. If or when it comes, the correction will probably affect markets worldwide. That said, it is important to underscore that we don't expect such a correction to signal the beginning of a new bear market, at least not for a while. Bear markets are typically associated with recessions, and Camarda does not think that's in the cards yet for the U.S. The U.S. expansion continues very strongly. Still, the U.S. economy and stock markets led the world out of the darkness of the Great Recession and will probably begin to falter long before other parts of the world stumble themselves. And as expanded in upcoming videos, U.S. stocks look really, really pricey and overvalued compared to other markets. While things still look good, we think it's time to reconsider investment strategies. And I'm very serious about this time for you, so please pay attention. For these reasons, we think it's important for investors to consider a serious shift from a concentration in U.S. stocks to a more globally diversified portfolio, and to concentrate on value stocks even more than ever. In a nutshell, we think you should stay in stocks and weather the correction that we expect, but get serious about repositioning your stock allocation to reduce U.S. exposure. As you go through this month's other investment articles and videos, please do bear this in mind. This is really important. Don't let the witch get you. For now, I'm Dr. Jeff Camarda, wishing you the very best of wealth. Till next time, thanks for watching.